Hello everyone, welcome back to my YouTube channel. In the last class, we learnt about depreciation, meaning causes and the factors affecting the amount of depreciation, right? So in today's class, we are going to learn methods of calculating the depreciation amount. Methods of calculating the depreciation amount. So first, let's recall what is depreciation. Depreciation, it is the reduction in the value of tangible assets that is due to usage, passage of time, wear and tear or obsolescence, right? See, when we buy an asset like a machinery, a building or furniture, it does not last forever, right? So we have to spread its cost over its useful life. We have to spread its cost over useful life like 7 years or 8 years, 10 years. That is depreciation. Clear? See, we can calculate depreciation in different ways. And that is depending on how the asset is used. So let's go through the main methods one by one. So in that first one is straight line method, that is SLM. See, it means this method, it is based on the assumption of equal usage of the asset, equal usage. In straight line method, it is based on the assumption of equal usage of the asset over its entire useful life. It means the benefit we get from the asset is equal every year. So the loss in value is also equal every year. The benefit we get from the asset is equal and every year. So the loss in value also equal every year. Clear? For example, if we buy a machine and use it the same amount each year, it will lose the same value each year, right? So depreciation charged equally. That is what straight line method. See here, it is also called fixed installment method because the amount of depreciation that remains constant, because the depreciation amount that remains constant from year to year over the useful life of the asset. So that's why we will call it as a fixed installment method, because here the depreciation amount that is equal every year, means that is over the useful life of the asset. Clear? So according to this method, a fixed and equal amount is charged as depreciation. That is what I said, right? In every accounting period during the lifetime of an asset. And the amount annually charged as depreciation in such that it reduces the original cost of the asset to its scrap value at the end of its useful life. It means what? The amount annually charged as depreciation in such that it reduces the original cost of the asset to its scrap value at the end of its useful life. Scrap value, it means what? It means the amount we expect to get when we sell the asset at the end of its useful life. It means the amount we expect to get when we sell the asset at the end of its useful life, means it's like the leftover value after the asset is fully used. Clear? It's like the leftover value after the asset is fully used. For example, see, if you use a machine for many years and it cannot be used anymore. You have used the machine for several years and it cannot be used anymore, so you might sell it as old metal or any machine for rupees how much, that is assumed rupees 10,000. That rupees 10,000, it is the scrap value. Again, I will explain you. If you use a machine for several years and you cannot be used it anymore, then you might sell that old machine for rupees 10,000. That is that rupees 10,000. That is the scrap value. That is what? It's like the leftover value after the asset is fully used. After the asset is fully used. Clear? So I hope scrap value it is clear to you all. Now next. See here, the depreciation amount to be provided under this method is computed by using the following formula, that is depreciation equals to cost of asset minus estimated net residual value and divided by estimated useful life of the asset. Estimated useful life of the asset. So here the example is, 1 minute. See, sorry, example, let's see the example. Cost equals to rupees 1 lakh and residual value, that is rupees 10,000, and life 5 years. What is the depreciation? Here depreciation, that is equals to cost of the asset. How much? That is rupees 1 lakh. And estimated net residual value, how much? That is rupees 10,000 divided by useful life of the asset, means it is nothing but scrap value. Clear? An estimated net residual value means scrap value divided by useful life of the asset 5 years. So 1 lakh minus 10,000 divided by 5 equals to rupees 18,000. So rupees 18,000, it is the depreciation, and it is same over the useful life of the asset under straight line method. See, in straight line method, we decide the depreciation amount in such a way that by the time the asset life is over, its value comes down from the original purchase price to its scrap value. Right? See, for example, if we buy a machine for rupees 1 lakh and expect to sell it for rupees 10,000 after 5 years, we will spread rupees 90,000 loss, means 1 lakh minus 10,000, equally over 5 years. This way, at the end of its life, only the scrap value is left in the books. So finally, we charge equal depreciation, that is rupees 18,000 every year. And the scrap value that is left in the books, clear, that is rupees 10,000. Clear? So I hope this is clear to you all. Now see here, this method, it is also known as fixed percentage on original cost method, because same percentage of the original cost is written off as depreciation from year to year. Means this is also called as fixed percentage on original cost method because every year we calculate the depreciation on the original purchase price of the asset, right? Not on the reduced value. Remember this one. So since the percentage stays the same each year, the depreciation amount also stays the same. That's why we will call it as a fixed percentage on original cost method. Here, now how we will calculate the depreciation in this case? That is, rate of depreciation equals to annual depreciation divided by cost of asset into 100. Here fixed percentage, that we will calculate annual depreciation divided by cost of asset into 100, or rate of depreciation equals to cost of asset minus scrap value divided by cost of asset into useful life into 100. In this way also we can calculate. See here, for example, cost of asset 1 lakh, scrap value 10,000, life 5 years. See, annual depreciation, that is 18,000. We know, right? That is cost of the asset minus scrap value divided by useful life. Now we need to calculate the rate of depreciation. That is cost annual depreciation, how much? 18,000, and cost of asset rupees 1 lakh into 100, that is 18%. Means so the rate of depreciation is 18% per year under straight line method. Clear? So I hope this is clear to you all. Under straight line method, the depreciation amount that is same over the useful life of the asset. Remember this one. And second method for calculating the depreciation, it is written down value method. Written down value method. So this is also known as diminishing balance method or reducing balance method. In this method, depreciation is charged every year at a fixed percentage. Clear? Depreciation is charged every year at a fixed percentage, but it is calculated on the book value of the asset at the beginning of the year. But here it is calculated on the book value of the asset. Book value means what? Cost of the asset minus depreciation already charged in the previous year. In straight line method, we will consider the original cost purchase price of the asset, but here we will calculate the depreciation on the book value of the asset. Book value means cost of the asset minus depreciation already charged in the previous year. So the amount of depreciation goes on reducing every year. That's why we will call it as a reducing balance method or diminishing balance method. So I will explain through one example. See here, suppose we purchase a machine for rupees 1 lakh and charge depreciation at 10% per year on written down value. Clear? So, year 1. In the first year, how we will calculate the depreciation? 10% of rupees 1 lakh equals to rupees 10,000. Means closing book value how much? 1 lakh minus 10,000 equals to rupees 90,000. And year 2, depreciation, now we have to take into consider this amount, book value, that is rupees 90,000. So 10% of 90,000 how much? Rupees 9,000. So 90,000, that is our book value, minus depreciation, it is 9,000. So 81,000, that is our second year depreciation. See here the value is goes on reducing every year. In the first year it's 90,000, second year 81,000, and third year 72,900. So and so on. Every year depreciation becomes smaller. Every year depreciation it becomes smaller. Clear? So this is what a written down value method. Clear? So I hope this method is also clear to you all. I hope this concept is clear to you all. First one, that is straight line method, and second one is a written down value method. So in the straight line method, depreciation it will be same over the useful life of the asset, but in under written down value method the amount of depreciation goes on reducing every year. Clear? So if you have any doubts, please leave a comment. Thank you.